Financial illiteracy costs Americans over $240 billion every year. But it's not just numbers or circumstance. Our behavior quietly drives every financial decision we make. Today, on Escape the Clock, I'm joined by a behavioral finance expert to show you how to harness the hardwired traits that fuel your plan and retrain the ones that drain your wealth. Stay tuned. Hey y'all, welcome back to Escape the Clock. I'm your host, the author of the book, and I'm here to help discuss strategies for long-term financial freedom. Today, we're exploring a hidden force that impacts every financial decision we make, our own behavior. While we often think of finance as a world of numbers, charts, and logical decisions, the reality is that our emotions and biases can be one of our biggest financial liabilities. Research shows that financial literacy costs the average American more than $1,000 a year, and the collective lack of knowledge and bad decision-making costs our country over $240 billion annually. This isn't just about not knowing how to calculate compound interest. It's about the psychological biases that lead us to chase trends, sell assets during a panic, and hold on to losing investments for too long. Mistakes that can cost us dearly and derail our long-term goals. So how do we move from being our own worst enemy to our greatest asset when it comes to money? How can we understand the why behind our financial choices to build a more secure future? Well, that's exactly what today's guest is here to help us figure out. My guest today is a pioneer in a fascinating field that sits at the intersection of psychology, finance, and technology. Hugh Massie is the founder and CEO of DNA Behavior International, a company dedicated to helping people understand their hardwired behaviors to make better financial and life decisions. A self-described reformed CPA, Hugh has dedicated his career to proving that our behavior, not just our bank account, is the key to true success. He's the author of 2 books, Financial DNA and Leadership Behavior DNA, and a visionary who's mentored millions of people across the globe. Hugh, welcome to the podcast.
Yeah, it's great to be here today and to talk about this important topic. And, I love the fact that you've said I'm a reformed accountant, because that's I think really big to the whole message.
Yeah, absolutely. I actually love your journey. And I think your books are really important. And I do think this is one of the most important topics we talk about. So I'd love to jump right in. Can you tell the audience a little bit more about your journey and how you got into behavioral finance?
So everybody can probably now tell from my accent that I'm not from the United States, although I live in Atlanta, Georgia, where I have been here for the past 20 years or so. So I came from Australia, and my career started off as a CPA, or in Australia we call that a chartered accountant. So I was very much focused on the numbers. I was actually an auditor and then became a tax specialist. That's really where I spent most of my career and in accountancy before I started a wealth management business. And when I started my wealth management business way back in 1996, I had the goal of wanting to put a tailor-made suit on every person. I didn't think that the private banks and the financial planners at the time were really doing that. There was a lot more of a one-size-fits-all approach. I think the world's come a long way since then, but that's what was certainly my motivator and still is today in personalizing the experience. But what I realized was a few years into that journey, if I was going to do that really well, I needed to understand how people behaved with money. And that's what got my human behavior journey going. A friend asked me, Hugh, what's your real purpose? And I this came from the subconscious. I'd never said it before with such clarity. I want to help people all over the world become financially self-empowered. And I think that really as I thought about it more afterwards, because I was so shocked I said that, but I knew it was real, that financial literacy isn't, for me, so much teaching people about what a stock or a bond is or compound interest, like you were talking about just now in introducing me. It was more about people's behavior, and that we all as individuals have talents, which are going to help us make money, and we have a financial personality that's going to drive a lot of our decision making. And that's what needs to be understood. And most of that is ingrained, believe it or not, from very early in life, because under pressure, we revert to our natural instinctive behaviors. And when I connected the dots on all of that, that's really when I went on a path to build a behavioral discovery system. We called it financial DNA at the time. And we still do, but the business is called DNA Behavior. That's really what put me on the path. And so it was passion led, but there was a lot going on before I really got clarity of my passion. And today that's what I've been doing for the past 25 years. And this whole field of behavioral finance has been gradually coming along. There's been some well-known people get Nobel Prizes for research work, but what's important is how we put it into action.
It's funny when you said your behavior, I actually got kind of chills there because I would say it was almost like listening to myself a little bit when you were talking, because I feel so much that my purpose accidentally became trying to do the same thing, especially in the United States, where
Yeah.
there is such a large illiteracy and issues with, systemic debt and financial troubles and lack of retirement accounts. I love a lot of what you're trying to do here. And I do think purpose and behavior are two important things that people don't really think about when they think about financial planning. There's a lot of the common strategies and stuff. And, I'm trying, I get through all that. I want to get through all that so we can talk about this stuff, because
Yeah.
this is the stuff that can bite you if you don't think about it. So let me ask you this, because the listeners might not be familiar as much with your work. This core concept you have of behavioral DNA, can you describe what that is, and what does it mean to be kind of hardwired?
Yeah, so all of us have got a hard wiring in terms of how we act, how we relate to others, how we work, how we make decisions. And that's formed from very early in life. And if you think about it, at the point of conception, you're given your genetics, and from that moment on, you go through series of life experiences. Believe it or not, in your mother's womb, you go through life experiences. And you get born, and then let's say you go to about 3 years old. Research now shows that 85% of how you're hardwired, or how you will naturally or instinctively make decisions and operate, is formed. And you can see that a lot of the time in your children. And that's why you'll see siblings in the same family operating very differently. They've come from largely the same home, but they're operating within that home and in the life differently, even though they might have been given the same opportunities. And so that's really what we're talking about, is the natural instinctive behavior. It's the automatic hardwired behavior that is really with you for all of your life. Now, does that mean that you can't do anything about it? You can. You can do a lot of work on understanding yourself and appreciating and working on the strengths and struggles that brings, so that you make decisions that are related to your strengths, or you capitalize on the strengths from your natural instinctive behavior, and you work on strategies to deal with the struggles, which are the other side of the strengths, or they're the strength overplayed. But always understanding that under pressure, you're going to revert back to that natural instinctive behavior. And I suppose if I use a simple example, I play quite a lot of sports, tennis, golf. But if I just talk about it sort of in tennis language, I learned very early on to play tennis a particular way, and over time a few bad habits have crept in. But while I can change that habit when I'm doing drills with a coach, because I'm thinking about it, it's in my conscious space. When I get into a match and the ball's going everywhere at pace, I go to my instincts. And so that's where then some of the bad habits show up, and I might lose the point or the game, if that makes sense. Now, if I do a lot of practice, I might be able to overcome some of what's ingrained in me, but it's really hard. And I think that I'm also about not trying to say to people to completely change. Work with what your natural talents are, but understand where they might get you into trouble. And that's sort of what I would say in the investing world: check yourself before you wreck yourself. So you can be aware of that instinctive behavior, what you might go and do, that you've got a predisposition to take risks, or you're overly cautious, or you're very detailed, and planned and save a lot, think about the consequences of that before you make a decision. That's sort of how that works, if that's being clear.
In your leadership behavior DNA book, I
Yeah,
kept thinking about real experiences from my life when
yeah,
I'd be at work and so I've been on both sides of it where, I was not the decision maker earlier in my career, always confused by what was happening with the
yeah.
leadership team, why they were doing what they were doing. And then in the room, making these decisions and seeing like kind of the back and forth and the struggles there, it really was fascinating hearing you talk about that because I know that a lot of the industry, especially right now, has this pressure cooker effect where everyone's being really pushed to perform much greater speed with a lot less time. And I think it's probably putting people back into their hardwired traits a lot harder than they realize they're being right there. So I love that this consciousness act, like you talk about, like you might not be able to change it in the moment, but you can practice at it. Do you see this as an issue that's kind of exasperated, especially with how industries nowadays are expecting so much more with so fewer people?
Yeah, absolutely. And I think that it's coming out everywhere. But if you look at it in businesses, I think you're right that businesses are being put under enormous pressure in a very competitive, fast-changing world. And given that a lot of the leaders of those businesses will be results-driven people, that's going to just push them into their hardwired drive for results and to get them quickly. And the cost might be, as I was explaining to a chairperson of a very major company that we probably all know. I won't use its name because I had that conversation today, but of this major S&P 500 company that, okay, you've got these great growth goals and the pressure's on to achieve them, but you won't achieve them if you don't recognize the psychological safety needs in the culture. And that a lot of great companies have fallen down when they've got too results driven and they've gone over that line of being too results driven and they've forgotten about the people and in particular psychological safety, which is sort of the relationship side that I talk about in the leadership book. And so leaders have got to be conscious of walking that balance. And that's where for some of them, they're going to have to step outside that their hardwired behavior of being very results driven to build enough relationship engagement. Otherwise, they won't get the results they want.
Yeah, that makes a lot of sense. And yeah, I can imagine if this is such a problem in everyone's, working days, probably everywhere in their lives, honestly, in our financial plans, a place where we really have to be cognizant of risk and our behaviors, it could really be something that we need to lean into. So let me ask you then.
There's a lot of dimensions to what you just said, but
I know,
why
I
don't you
know.
ask your question and I might unpack it a bit more.
Yeah, absolutely. And please, yeah, please dig into what you think is important here. But I was just going to ask you, like, for someone who's like, okay, I get it. This could get, I have these things. I know I have some hardwired traits. Like, which biases do you most see people getting kind of bit by, and what strategies do you start trying to help people to start to overcome this stuff? Because I think of things like overconfidence and loss aversion, confirmation bias. There's a lot of things that can lead to not the exact outcome that you're looking for, but it can get you.
Yeah, so I think that one of the obvious ones for people is taking too much risk. So being, with a drive, I suppose, to make money and wanting investment outperformance. We all want investment outperformance for varying reasons, either to achieve a lofty goal or it's just it feeds our ego, and or we can just see, more money, coming into to our investment accounts. But you've also got to be able to handle that when the market goes the wrong way. And so having a more balanced view of that is probably important, but risk is probably an obvious one. I think that for others, and you were alluding to this at the start, which is more coming from the loss aversion side and having regret. People have regret about decisions they've made. There's a bias called the disposition effect, where also people will sell a winner to take a profit off the table, but they don't want the conflict and the embarrassment, the pain of taking a loss. That might be a worse thing for them to be doing. That's something that's important. I think, an overall perspective with investing is buying an investment in a way, the buying inside is almost the easy part. Knowing when to sell is the harder part. And I think that's not just only true with equity type investments or fund investments, but it's also true with businesses, with any asset. And I think that's something that people need to really think about. But the other one that, was jumping into my mind when you brought up this question is one I think called following the herd. A lot of people start looking at what others are doing and they jump in. It's easy to go to a dinner party or go to a bar or a work function and listen to what stock positions, fund positions, assets others are buying and think, I'll go and do the same thing. And there's no research or consideration as to why they're doing it. They're just doing it because they see others doing it. And I think that's something that's very dangerous.
Yeah, absolutely. I can tell you, I've been a person that made all these mistakes. I think it's very logical when we say, okay, you should invest in something. And so, it's your logical mind probably when you start investing, but then after that, everything's your emotional mind. It feels like.
Yeah.
So it's like with me, when I was just doing investing during my career and not really looking or thinking about it, it was great. But then later when I'm like, okay, I build up this really nice portfolio and I have a lot of gains in these places and not so much in other places, whatever. But then you see people buying this stock and you're like, okay, well, there's a status quo thing going on there. Maybe I should be buying that. Or then I get into options trading and it's like, well, okay, now I'm selling an option that would have the obligation of having to let it go at some price that I set. And if the market goes way over that price, I'm going to have to sell it at that price.
Yeah.
And, you should be happy about that. You have gains on both. It's all upside. Yet there's something about, well, if I sell it, it's gone. And then I don't have it anymore. I lost ownership of it. And other people are still gaining and I'm not getting. So many emotional things that seem to start to pop up that we need to be aware of so that we can kind of check ourselves.
Yeah, I think that everybody's got to check themselves before they wreck themselves. And you've got to look at, what your goal is for the investments for the long term. And also what types of strategies can you actually handle as a person. Options isn't for everybody. Trading stocks and picking the positions isn't for everybody. When I was first in wealth management, that's a lot of what you did because there wasn't all the ETFs that are available today. And I think that the ETF structures are good for a lot of people because they don't have to worry about these day-to-day decisions if they've got their overall goal set and a broad structure, for a portfolio that fits them. I do believe that understanding enough of what you're investing in and doing is something that's also important, and that it's incumbent on everybody a little bit to be self-empowered enough to ask a few questions and learn enough about this to build a strategy and work with an advisor on that strategy, even if they don't know absolutely everything about it. But one also, I think, can get themselves over their head doing things that they don't understand. And that's a big problem.
I completely agree. There's not a one size fits all approach for folks, and
No.
personalizing things is the way to go. So can you maybe provide some examples of how like you would help someone have a personalized plan that aligns with their behavioral traits?
Well, I think the first step is sitting down and just understanding who the person is and understanding their goals, or with some people, actually just talking to them about their life desires. The word goal is a big turnoff, believe it or not, to a lot of people, and they have trouble articulating what those are. So, the other way around it is to talk to people about their desires. Now, I know all of that up front when I'm dealing with a person because, DNA behavior, we're profiling the person to understand who they are up front, what kind of language they're going to want, and probably get a fair idea of their suitability to the types of solutions they're going to want. So, for me, it's about still asking the person a whole lot of questions in a comfortable way. But, I think just really getting clear on goals or desires, the type of language that you use with a person to make them feel comfortable, because that's what's going to bring all that out. And then once we got an idea of the goals and the realism of those goals, because even if you have a desires type conversation, it does, in the end of the day, get to goals. So once you know where the person wants to go, then it's really talking about, okay, you're here now, and how much risk can you take? What are your savings patterns? I think that the biggest issue, and you were alluding to this before at the start, for people is saving. We talk in wealth management a lot about risk profiles till the cows come home, but maybe not about enough about people's savings propensities. And what budgets are they doing? And that's again where I start talking to people about, for some people it's a budget, for others for the spending type people it's a spending plan. Because if you don't save enough money, you haven't got the capital to even invest. That's just a fundamental point. You're probably in debt. That all needs to be addressed. They're the first things, and then once we get to the investment strategy itself, I'm going to show people more graphically, this is what it looks like if you've got a portfolio with this level of risk in it versus another level of risk. And what are you prepared to tolerate? And talk people through the types of investment structures they could have that might be a fit for them.
I love all this big, because I think a lot of what it comes down to is you're spending because
Yeah.
you need cash flow. And then with cash flow, you have decisions to make.
Yeah.
And some of that has to be saved because you need to smooth out your money for your future self. You need to have something for your future. You can't just,
Yeah.
you don't have an income at some point. But then the rest is about growing what you have. And that's where the investing comes in. And that does come down to risk, both your risk tolerance and your risk capacity. And so maybe you could go a little deeper into the financial DNA profiling that you do, because I do think it's a little different than some of the basic assessments that brokers and others typically do when they're doing basic goal setting. And also you're doing SMART goals, which is something I talk a lot about. I was a program manager. This is how we had big companies with thousands of people, all with their
Yeah.
own behaviors aligning on something, because we'd have measurable outcomes that we could drive people towards. So can you go a little bit deeper into the financial DNA profiling?
Yeah, so the financial DNA profiling was built to understand all of your whole personality, not just so in a way everything about you, not just a risk profile. I think that a lot of the brokerage houses use a pretty singular risk profile to then say you should invest because of who you are. You're now on this continuum. They're asking 5 to 10 questions a lot of the time. The better ones might be a little bit longer than that. And a lot of the time, those questions are very difficult for someone even educated at a reasonable level to understand. What are you going to do if the market went down 20%, or what's your reaction when you lose a job, and rank these responses 1 to 5. That's quite hard to do, and we went about it in the question design very differently, and that might be to understand how someone would react or behave without situational bias. But I won't get into too much of the question side, but what we bring out in the financial DNA is we do bring out risk, but we address it at a couple of dimensions, because there is, firstly, will you take a risk versus how will you live with the consequences of taking a risk, which is the risk tolerance. So some people I see are prepared to take risks, but they actually haven't got the risk tolerance. And then there's another whole thing called financial capacity, which is really a financial calculation. What actual risk can you take? Well, there's no point taking risks behaviorally that is higher than your risk capacity. That's just going to cause massive problems. So addressing that is something that we do and advocate. And then I am looking at whether a person is a spender or a saver. So that's something that we bring out. We look at a person's goal setting desire. So some of us in the world, like people like me who are an entrepreneur, are very heavily weighted to setting ambitious goals, not only for our businesses, but our life in general and financially. And we don't like seeing low rates of return on the page. That's just not something that we handle very well. And I had a client a few years ago that had sold his business, and he was a born risk taker. He was 38 years old. He'd made $10 million. This is quite a few years ago. Before people made hundreds of millions, he made 10 million, which I thought was pretty good for a 38-year-old on his first business, wife and 3 kids at home. And he said to me, Hugh, I don't want to take any risk with this money. And I knew that he would. So what we did the financial DNA on him, and no surprise, he's very goal-driven and a big risk taker. But he didn't want to take risk with his plan. So we built a portfolio to start with that was pretty cautious. And first meeting around, he said, well, where are all the returns? And you said, well, you didn't want to take any risk. The next time round, we built in 20% of the portfolio to take more risk. And he still wanted more returns. That journey went on for about 5 years till we got him more aligned. And I think that's what we're doing with financial DNA. And, the other part also is we are deploying the financial DNA discovery on the wife. Or on the partner. I don't want this to come across sexist, but sometimes it's the male that's the dominant decision maker. Other times it's the female, and one should never underestimate the role of the female in the home, the needs in the home, and making sure that all of that's taken care of. And sometimes the female is actually a higher risk taker and more goal driven than the male. So all those things need to be known. Sort of where's the power in the financial relationship? That's something that's important. So we talked about risk, goals, spending. We will look at how does someone think in terms of an innovative way. So some people are more attracted to new ideas, new solutions. Others are very anchored. They just want to do what they know. We will talk about following the herd because bet your bottom dollar in most couples, one will be a herd follower. They're going to be that more extroverted person that's looking what everybody else does. And that also drives a lot of the spending in the household. So understanding that. And there will be one of the couple will have that sort of disposition effect, happy selling a winner, holding on to the losers. So, looking at all of the decision-making biases is what we do. And we unpack those. And everybody's got a few that are stronger than the rest of the universe. And that's what drives the conversation. And then hopefully, if you've got a husband and wife sitting in front of you or partners sitting in front of you, you can reach a middle ground somewhere, not necessarily a middle ground of dividing your behaviors in two and averaging it, but somewhere something that you both can live with.
Yeah, the dynamics of the household, everyone that can affect your financial outcomes. I think you have to keep them involved, even like kids, right? I talk about speaking to your children because your children don't only influence your spending, but how much you're saving, especially if you're saving for something really expensive like higher education. And the more financially literate they are, ideally, the more responsible they'll be with their own financial independence, and potentially there's a return there because they can help you later in life as well. So I feel like there's a lot of behaviors in the mix.
Well, one thing I want to say is that the communication of all of this from the advisor or the digital platform that's being used is really important because, what we're talking a lot about here is trust. We're talking about trust in yourself to make the right decisions, trust in others, whether it's your advisor or your spouse. And so how information is presented to people is really, really important. And, I've seen situations where, for example, the advisor is the more extroverted, bigger in the room person, doesn't matter whether they're male or female, and they're able to present the big picture really well. But sitting in front of them are engineering type clients who want to see all the details. They actually want to see the research reports. And if you don't provide all of that, they'll never trust you. Now, it's true on the other side. If the advisor comes in with too much detail and overwhelms the client and all they want is the big picture to make a decision, you lose the game there. So understanding how people want information communicated to them is important. The tone of it is really important as well.
Yeah, absolutely. Well, Hugh, this has been amazing. I really appreciate you being here to demystify a lot of this. How can listeners connect with you?
So the best way to learn more about me is you can go to my LinkedIn account. There's plenty said there. So Hugh Massie, Massie in LinkedIn, and then also you can go to dnabehavior.com and there's lots of content there to read. Blogs, white papers, podcasts. Everything is there to learn more about how it works, and anyone's free to take a trial as well.
As we wrap up today's conversation with Hugh Massie, I want to pause on some of the powerful insights that he shared. What really struck me is how much of our financial behavior is shaped long before we even make our first investment. By age 3, most of our hardwired instincts are already formed. And those instincts, whether we're risk takers, cautious savers, or herd followers, they show up every time we make a money decision. That's why Hugh's reminder to check yourself before you wreck yourself is so important. The math of investing is often straightforward. But our emotions, our biases, these are the things that get us in trouble. We've all felt the urge to chase what everyone else is buying, cling to a losing stock out of regret, or hold back from taking a necessary risk. Recognizing that these impulses come from wiring that we can't completely change, that helps us focus on building strategies to manage them instead. And that brings us to a crucial point about personalization. There's no universal plan that works for everyone. Your financial strategy needs to reflect your unique wiring and your goals, or even just your desires. For some, that means detailed spreadsheets and research reports, but for others, it's the big picture and broad strokes. The key is that it fits you, not the other way around. Hugh even highlighted how a simple shift in language from budget to spending plan can make all the difference in aligning with your natural tendencies. Hugh's work goes beyond just risk tolerance. He explained the difference between the risk you're willing to take, the risk that you can handle emotionally, and the risk your finances can actually support. It's this deep, layered understanding of our financial DNA that allows us to build a plan that's not just smart on paper, but sustainable for our lives. This requires a different kind of trust. Trust in yourself to make decisions aligned with your long-term goals, trust with your advisors who need to communicate in a way that connects with you, and trust with your family. Because money is never just about one person. It's about the people it impacts most directly. Ultimately, achieving financial independence comes down to self-awareness. As you move through this week, take a moment to reflect on your own wiring. Where are you strong? Where do you get tripped up? What strategies can you put in place to balance those instincts? That self-awareness could be the difference between drifting off course and staying on the path to lasting financial independence. Because when you understand your behavior, you give yourself the tools not to only grow your money, but to sustain your freedom once you've escaped the clock. As always, I want to hear from you. What are your strongest behaviors when it comes to achieving your financial goals? And what are you working on changing? Thanks for listening, and best of luck using the best of your behavioral DNA to escape the clock. I'll see you next week. Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.